Hi, and welcome back again to Big Time Options, Edges and Hedges. We'll take a look at our follow-up to our previous video on why IV matters as far as selecting trade structure and also putting on the trade. So we'll go through how our most recent trade, based on a big spike in implied volatility on the triple Qs, worked out, and worked out quite nicely. So here was the original trade recommendation from March 7th, basically selling out of the money put spread on the triple Qs, the 455, 460. This was mentioned in the previous video that the Q finally finding a little footing after a big sell-off, right? IV also popping, as we'll see in a second, to the highest levels of the year, but starting to soften a little bit. So taking advantage, positioning with an out-of-the-money bullish put spread on the triple Qs, buying the March 21st, the traditional expiration 455 put, selling the 460 puts, getting right around 75 cents, give or take. Here's the actual fills, some at 75, 77, 78, so right around that 78-cent net credit or so. Then fast forward to March 13th, right? IV starting to weaken a little more and the market starting to firm. Market actually dropped a little bit, but finally showing some semblance of sanity. So let's still take advantage of IV that's elevated, albeit off the highs, and a perceived sideways scenario by hedging that previously sold bullish put spread with a shorter term and tighter. Original trade was 5 points. The new hedge is only 3 points wide call spread to kind of put on an iron condor with a diagonal approach to it. So it was simply going out, buying the March 14th, right, 488 calls, selling the 485 calls, so 3 point wide, expiring March 14th, a week earlier, right? Same amount of contracts too, for a 58-cent net credit. That spread did indeed March 14th expire worthless, so we were able to hedge, bring in another 58 cents net credit. Then on March 17th, we saw the market still start to, kind of just hang around where it was. IV dropping a little bit more, right? The market firming up a little bit more. So we took advantage of this kind of go nowhere market with the still comparatively high IV by selling another 3 point wide shorter term call spread against our longer term put spread. So selling the March 19th expiration 3 point wide 490, 493 call spread for 56 cents. That did expire worthless as well, so we were able to bring in that 56 cents, keep that credit. So here's kind of the summary on it, right? Our initial put spread trade, we got 78 cents or so net credit, hedged it on March 13th for 58 cents, hedged it again on March 17th because the previous short call spread had expired for 56 cents. So got about $1.90 or so total net credit between the three trades, right? And then as we see, that late, on Friday, market certainly went out no problem at all. We see the Qs closed well above that 460 level, so all three spreads expired worthless. Got to keep that 192 total net credit. We brought in the combination of our original put spread and then the two hedges, what I call chopping wood, right? Keep selling premium against your initial position. And you can see it was really predicated for the most part on this huge spike in IV. Here is where we put on our initial put spread trade, and then you see it start to weaken. A benefit, obviously, to the IV selling it at extremes, buying it back cheaper. Our previous video went through just how big an edge we perceive we had. And taking a look at the market, you can see here's the date we put on that initial put spread, right, with the Qs trading, right around that level. We actually put it on near the lows of the day as the Qs closed at 491, but when you look back at where we put our trade on, right, Qs were trading at 486 and change as far as the price on that. You can see really did not move, drop too much, never really threatened too badly going in the money on the put spread side, right? Or conversely on that call spread, the two sets of call spreads we sold, never really threatened going in the money there as well. So I ended up working, here's the day of the first call spread, right, where we put that on. Here's the day of the second call spread. Here's expiration. As you can see, the Q's closed right around that 480-ish level, 480.84 to be exact. So certainly the remaining 460, 455 put spread could just leave it alone. So that's how we go about looking to take advantage of market edges out there and then put on the hedge. In this case, we are able to put on 2 subsequent hedges to bring in more premium and bring our profit potential up, which ended up being realized. So until next time, as always, here's the good trading. Take care.